Welcome, everyone. It's Angelo Robles, host of the Angelo Robles podcast and the founder at Family Office Association. Today, we're going to cover Extraordinary Investor on how to make money in stocks and crypto. A little bit of a different bent because the subtitle is AI, the answer. We're going to cover many topics in this long form interview, including a look at the year ahead, raising interest rates, rising inflation, lots of challenges on the regulatory front from a crypto perspective. So buckle up, stay tuned. This will be a long one and a great one. Our special guest today is Max Gokhman, CIO of AlphaTrAI. It's really a pleasure to have Max on. Again, he's the CIO of a very intriguing company, AlphaTrAI, an asset manager harnessing the power of authentic artificial intelligence. In his role, the lead investment, R&D, risk management, and thought leadership for the firm. Previously, Max was the head of asset allocation for Pacific Life's $33 billion multi-asset division. Max, it's a pleasure. Welcome to the show.
Thanks so much for having me, Angelo. It's great to be here.
Well, as I kind of cue things up, we have a lot of things to cover before we inevitably lead to the big picture questions in the title, how to make money in stocks and crypto. So why don't we start? So for context, we're mid-late January 2022. We now have a clear picture of how things evolved last year with interest rates, with inflation. So the government's telling us we had close to 5% inflation last year. I'm going to look at that and laugh. I think that's complete nonsense. And if you're a ultra high net worth individual active in buying things that are rapidly going up in value and living a certain lifestyle and buying properties in expensive markets around the world, I mean, I'm going to go with, of course, I have no facts to back it up, but with 20 to 25% inflation. Am I crazy?
I would say the 20 to 25% number is maybe a little bit high, no matter how you slice it. But certainly, we've seen inflation is not uniform, and it's interesting in the sense that we have seen almost everything go up in price. So from things like rents to things like multi-family apartment buildings that will pay for those rents, right? So if you are on one end of the spectrum in that equation, it kind of hurts you. If you're on the other end of the spectrum in that equation, you could say it benefits you because the value of your asset went up, but it only went up in nominal, not real terms, of course. And that is something that investors always need to keep in mind. You know, I mean, there's a lot of folks here in Newport Beach who I've been getting really excited because we have been having a pretty good housing market. But to put it in that very simple context, if the value of my house went from 2 million to 2.5 million, but all the other houses in the area went up by the same amount proportionately, then I can't move anywhere. So that money is kind of meaningless. And I think that's the thing that folks need to really start getting a handle on when they think about inflation is where is inflation relatively lower? If you're looking at making a purchase right now on an asset, where is inflation that of something you own has been higher than inflation on something you don't own? And that's where you can make that arbitrage. But I would say the 5% figure is definitely lower than what most folks have experienced. I would agree with you there, Angelo.
I mean, there are some people that would say, I'm not saying I agree with it, but it does kind of simplify matters with the cost of goods or quote unquote inflation. Should you tier it to what the S&P went up? What if you're very active in crypto, what your crypto portfolio went up, assuming you want to buy more of it. If you want to buy more of it, it's going up a lot. And even my number may actually be a little on the conservative side.
Yeah. And I think that's another thing that made people feel a little bit easier when, you know, at least individuals who have a significant allocation to equities, because yeah, we had a year where the S&P was up nearly 30%. And more importantly, it had a sharp or risk adjusted returns of 2.5, right? So you got 2.5 return points for every measure of risk. That is enough to smoke almost any hedge fund. And you could have gotten that by just buying a low-cost spider. That's not normal. That's not something that I think we'll continue to see, but it made that tough inflation pill a lot easier to swallow.
Well, let's talk a little bit about what, the Biden administration, what's happening around the world, COVID. I mean, all these things are going to play into it, which we'll get into in terms of what the economic picture could look like. So putting on your economist hat, with which your background is very easy to do. Really excited to ask you a lot of questions. Inflation just kind of cued it off. What do you think is going to happen with interest rates? I think we have a little bit of a headwind in terms of what's likely to happen. Is it going to go up? Is it going to go up multiple times? How many? And what amount is it going to go up? 25 basis points each time or more?
I think the Fed is going to start hiking at a pretty high clip. And there's a reason why I say this. We saw almost all of the most dovish members of the FOMC suddenly turn very hawkish. And nothing that an FOMC committee member says is ever off script, by the way. There's coordination when that happens. So it sends a signal, and investors who've been around, especially fixed income markets, know this, that when someone like Brainerd, who's generally been dovish or Bullard, when they say, yeah, we think maybe we should have 1 or 2 hikes this year, when before they were saying, oh, no way, we should keep rates low forever. That's a coordinated message. And it sends a very strong signal to me that the Fed has made a dramatic pivot. And this happened relatively quickly, really from, I would say, the Jackson Hole meetings in August to the end of the year. It was one of the fastest transitions from very dovish and accommodative to very hawkish. And we kind of saw the last leg of that when the minutes got released in January, where the Fed said, not only are we going to raise interest rates, not only are we going to slow down asset purchases, we're actually going to start doing quantitative tightening or shrinking the size of the balance sheet. So with all that in the picture, it's really hard to see how interest rates across the yield curve don't go up, and in a pretty meaningful way.
Okay, and that appears like it may be trending in that direction. But what else is happening this year as well is later this year we have the midterm elections. I mean, if my assumption would be, and of course, when you assume something, probably the opposite happens. If interest rates go up more than a little, let's call it a lot, and consistency or consistently, this could wreck the market. This could be devastating to crypto and to the stock market.
It definitely can be. And I think what we're going to see is a correction within the cycle. And we should definitely talk about the business cycle a little bit, because this is a very unique business cycle we're living in. It is perhaps the shortest business cycle we will ever have in our lives. And I think that's a fundamental lens that I've been having throughout this entire period. What I mean by that is we had probably the shortest recession ever in history at about 1 month in March of 2020. Then we had a very fast recovery. Then through the middle to the end of 2021, we went through the early expansion phase, and now we're actually in a late expansion. So this would be, if you want to look at it through the lens of the previous business cycle, kind of at 2011 through 2015 period. We're in it already right now. And in that period, things get a little more dicey. They get more volatile, and you do have corrections. And I think we're likely to experience that. Now, with that, my price target for the S&P for 2022 is 5,000. So I think we're going to have slight single-digit gains, but it's not going to be a straight ride.
Oh, that's for sure. I mean, that's how it does look like it's shaping up. So, I mean, I'm still going to go back to that question. Like, that's the whole challenge for investors is they're active in the market, they're in equities, they're in crypto. If you look at how things likely will play out, this may not be a good couple of months or possibly longer. Now, kind of like you said, it may not be a classic bear market. It may not last as long. From a political perspective, I could see them raising interest rates. Things look really bad. Midterm elections coming up, Biden's approval numbers being horrific, that they may reverse course. I mean, we don't have a crystal ball, so we don't know. But this will be an interesting year. Why don't we put it at that?
I think it will. And I think with one thing about interest rates and the Fed pivoting, it's really crucial for the Fed to not appear like they just change direction too quickly. They're not a tactical central bank, right? There's other central banks in the world, like in Turkey, that maybe are going to kind of do random things sometimes at the behest of the president, but the Fed is not going to do that. We saw it in the last administration. I think we're going to see that in this administration as well. And in fact, it's still Powell running the ship, which I think was a very prudent choice to not change your pilots in the middle of a very tricky landing, and now actually in the middle of a very tricky takeoff as went from quantitative easing to quantitative tightening all in one go. But this is where it gets trickier for the Fed still. If we see that the economy is slowing down too much, or if we actually see inflation starting to go away a little bit, and the Fed is still on that tightening cycle, it's going to be really tough for them to pivot. And that's the thing I'm worried about. In addition to that, you mentioned the midterms a few times, and let's look at that as well, because one thing we know about the midterms is that is when politicians tried their best to stay in office. That's a very obvious statement, right? But let's examine that within the context of what's on the table right now. So we still have Build Back Better as a proposition. It's been getting absolutely attacked by Biden's own party, really two members specifically, of course. And I do think that Build Back Better passes, but I think we'll start seeing things get really wonky in what's in and out of the bill just to get an agreement as we get into the midterms. And this is where, having been a macro investor for a while, I've gotten pretty used to reading really long and boring, legislation. This is going to be something that's absolutely critical for investors to go through, because there will be parts in that bill that are going to be surprisingly important. And it could be as small as like 2 or 3 lines about, say, R&D expenses versus depreciation for software companies. That's actually one of the provisions that may be expiring, which was part of the 2017 Tax Reform Act. Well, if that changes, that has pretty big implications for a big swath of the S&P.
Oh, for sure. And if what you think could play out with interest rates, with inflation, such an interesting year, what sectors from a stock perspective, what's going to be, what's a flight to safety?
Yeah. And I think, unfortunately, I don't have a simple answer for you here, because it's something that's probabilistically tied to a certain events happening. So, for example, let's say Build Back Better does pass. Well, the rational thing to do would be to go into sectors like materials and industrials, because they're going to be direct beneficiaries. It would make sense to go more into small caps than large caps, because small caps are more domestically focused in the US. Therefore, they're going to benefit more from shovel-ready projects. We also know that typically with these infrastructure bills, a lot of the spending is front-loaded. So that's going to give them an immediate lift. Conversely, let's say that R&D expensing provision does get taken out. Well, that's going to be bad for tech. Conversely, if Build Back Better does not pass, then you want to look at what else is going on with the world. Are supply chain problems still here? Then maybe logistics companies are going to be more in demand, because if they can kind of innovate through that and get goods here quicker, that starts making them look better. So it's not straightforward, and that's a tricky thing about this year. I think is it's going to have a lot of twists and turns. To me, this is much more of a stock picker's year than it is a year for big, bold macro calls, because they're going to be highly conditional.
We didn't even talk too much about the impact of supply chain challenges, and how do you think that will play out relative to the economic picture?
So I think with supply chains, we've got 2 separate issues. We've got the kind of pure bottleneck supply chain issues, which we saw a lot of in 2021. So out here in California, if I look out at the ocean, even though I'm in Newport, quite a ways away from the port of Long Beach, I can still see the cargo ships. So literally just, cargo that cannot get unloaded. And that was in part because of COVID, because of lack of labor. Now, some of that, in fact, I would say a big chunk of that gets resolved this year, and that's great. Mm-hmm. However, it creates other problems. So we've seen a lot of retailers, especially, for instance, load up on inventory. We've seen the fastest inventory buildup in a long time last year. So all of a sudden, now that supply all comes online, and there's too much inventory in the marketplace. So does that create a problem? And actually, interestingly enough, a deflationary problem for that sector? I think it will. So that's one part, which in itself is complex of supply chains. The other part is things that are unrelated to logistics. So this, a biggest, simplest example to illustrate this is semiconductors. So simply put, we have far more structural demand for semiconductors than we have facilities. And fab facilities, which are used to make semiconductors, are extremely expensive and take a very long time to build. And really, the semiconductor industry is really concentrated within Taiwan and South Korea. So there, and this is something that's certainly impacting automakers, which is what a lot of the headlights have been about, but it's impacting a lot of other sectors as well. There's very few hardware devices that don't use a semiconductor right now. And when I say hardware, I mean things like your toothbrush. But also a lot of software requires compute power, and that requires semis. And there's really very, very few things in the world that do not in some way, shape, or form need more semiconductors. And that is an issue, but I don't think it's going to go away. So, the takeaways from an investment perspective is, well, it makes me bullish on semiconductor stocks from a structural perspective, but it's also that bullish view is contingent on them being able to actually build new facilities, right? So TSMC is going to be building new facilities in Arizona, for instance. That's great, but it's going to take time. And it's going to take some countries like India, for instance, which is now looking at creating incentives. The US is looking to create incentives again, part of Build Back Better. There's I would say, a very, very insignificantly small sliver allocated to helping semiconductors. I think we need to do a lot more in the US to incentivize companies, but it's still that there's a recognition by global governments that we need to enable more semiconductor manufacturing. And that over time, and now we're talking like well past 2025, that will resolve that issue. But until then, it's going to be real tough to get through that shortage, because that is what I would call a structural, not a cyclical shortage at this point.
And okay, since you indirectly brought up the topic, I guess I have to ask, because it does play into the global economic picture, China, Taiwan, and what else is out there from Russia to North Korea? I mean, I was going to say we're living in very trying times that are challenging, but you could look back through decades and hundreds of years. There's always something. There's never complete global peace. Actually, some people say, other than maybe COVID, which we'll get to, this may be relatively a more peaceful time.
It has been a more peaceful time so far. And I think part of that has been this global connectedness that we've had, right? So we've kind of swapped our guns and missiles for cargo ships and just-in-time inventory. And that's been great. Unfortunately, we've seen a trend of deglobalization, and we've seen, a lot of companies go from just-in-time to just-in-case inventory management, where a company may have their prime apparel manufacturing facility in China, but they're also built one and staffed it with some folks in Vietnam, so they're actually hedging those geopolitical risks. So what that does is it reduces the impetus for governments to actually get kinetic, because they know that they're not going to completely destroy their industries. Now, again, we're talking now multi-year secular shifts, but these are very important things for long-term investors to consider. If globalization goes away, it does raise the prospect of kinetic conflict, and that is a very dangerous prospect. Now, what does kinetic conflict look like in the modern age is a whole different question. I'm not going to get into that right now, but specifically on the risk you mentioned, China and Taiwan, this is a tail risk. As in, I don't think it's something that's going to occur in 2022, but the risk that this has been growing. And, we saw, I think, something like 900 flyovers by Chinese military aircraft over Taiwan airspace in 2021, which was a dramatically higher number than we've seen in any other prior years. And China understands that as the rest of the world is really focused on battling COVID, dealing with their own inflation problems, dealing with monetary policy and fiscal policy, it gives them a little bit of opportunity to get a bit more aggressive. And it's a very delicate dance, because they also understand that if they were to, bluntly take over Taiwan, there would be repercussions because of how important Taiwan is to the global ecosystem. I mean, I always say Taiwan doesn't need a navy or an army. They just need TSMC. TSMC is the best national defense agency that any country has, because the rest of the world is so reliant on Taiwan Semiconductor. And how that plays out is important, because one thing we have seen last year from China is they've gotten a lot more aggressive in their policy. We saw that with their tech sector, with delisting certain companies. And to me, that's a sea change in President Xi Jinping's approach. How that impacts Taiwan is something I'll be watching extremely closely.
For sure. Let's talk a little bit about asset allocation, since that's a very important part of your background. We have, great investors and family offices that are going to be really interested. I'll start a little bit more mundane. The so-called 60-40 asset allocation, I've said, of course, it gets me in trouble, is that it's a fabrication of Wall Street to simplify for the masses investing in stocks and bonds. Now, you could argue, is that necessarily a bad thing? Maybe it is a little prepackaged and simplified. So one, I want your opinion about that. And two, how should a significant investor or family office look at asset allocation? What's different now than maybe in the past?
Sure. So it's a great question, and it's something that I've spent a lot of time managing balanced portfolios, especially in my previous role at Pacific Life. And I think the best way to look at things is not so much a 60-40, but rather the concept of different combinations of stocks and bonds, right? And looking at it through a risk lens. The reason 60-40 took off is because it had just enough bonds to be diversifying with enough equity to give you upside. And that works in an environment of secularly falling bond yields. So assuming bond yields keep falling, 60-40 looks pretty good because you make a little bit of money on bonds with very low risk. You make more money on equities, and in the 60-40 portfolio, usually equities are, still 80 to 90% of the risk, by the way. And that's the key component. The nominal figures matter a lot less. But at the same time, if we're now entering an environment where we're going to be in a secularly rising yield environment, all of a sudden 60-40 doesn't work so well anymore. And that hasn't been the case since 1982, by the way. That was the peak of the last bond bear run. And since then, you've at least on a secular year-over-year level, yields have generally been falling. And I think that's going to change now with everything that's going on, some of the things we already talked about. So as that's changing, 60-40 as a concept, which is to say you should be diversified, you should have some safe haven assets that protect you when your risk assets don't perform. That's a great concept. It doesn't work so well. And by the way, let's extend this beyond 60-40, because a lot of the sophisticated investors would say, well, yeah, 60-40 is old news, but risk parity, that still works, right?
Right.
Risk parity at a very simple level is just modifying that ratio constantly based on the realized risk of the asset. So you may hold a bit more bonds if bonds are relatively less risky than stocks. If risk on stocks goes up, you would deallocate some. But again, that still hinges on the same principle, that bonds are a diversifying asset and that interest rates and yields specifically are going to keep declining. If yields go up as stocks go down, risk parity doesn't work, 60-40 doesn't work. So I think investors are going to need to start looking for an alternative to a defensive, or if you will, all-weather portfolio. That's the big hurdle for institutions, for family offices, and even for individual investors as well. Because those old formulas are going to be real tough to navigate the new market realities with.
I mean, I suppose how it was traditionally done, you think I would know in the family office world, single family offices are what I do. They would develop usually an investment policy statement, there'd be a committee involved, there's a CIO, there's perhaps family engagement, outside advisors, and things move relatively slow, probably skewing towards the conservative side, probably leaning towards strategic, a little bit of set it and forget it asset allocation. Versus now, could you argue, in the markets that we're in, you're probably far better off being tactical. But yes, of course, you can make wrong decisions.
Yeah, so I think the one thing about it, because I always told this to all the researchers and analysts and PMs who work for me, is not making a decision is a decision. I think every investor needs to ingrain this in their mind. Not making a decision is a decision. So if you stay static, you've decided to continue to stay static even as facts around you have changed. Now, there is a way to take this way too far where you get super reactionary, and generally speaking, being reactionary does not work. When you think of a broader portfolio context, you don't want to be reallocating too often. When we're dealing with family offices, we're dealing with sometimes very illiquid assets where you can't reallocate anyways. But it doesn't mean you shouldn't have a plan. So when you look at your real estate holdings, when you look at your infrastructure holdings, other hard assets, there should be a plan around them. And the other thing that I've seen a lot of family offices do, unfortunately, is they don't realize the beta inherent in their assets. I've seen this a lot with folks who say, oh, I have all this private equity, and it really isn't correlated to the market. The reality is a little bit more nuanced. It's not marked to the market very often, right? Because you get your LP letter once a quarter, and it looks like, oh, this return is totally unrelated. But actually, if you were getting those assets marked every day, like you do with a public equities portfolio, you would see that there's private equity does have a beta to public equity, and it can be quite substantial. And so investors need to be aware of that. They need to be monitoring how their holdings are actually moving together in a more sophisticated way. And then they need to make long-term plans for reallocating based on, I would say, business cycles rather than specifically what's happening in the market, this month, this quarter, or even this year.
Good point. A little bit randomly, since we are going to also eventually get into AI, I think of tech and big tech and the FANG being plus Tesla, Microsoft being dominated by effectively technology companies. How do you think that could play out from a rocky and volatile year, or tech is often deflationary? So like, how do investors look to allocate towards larger tech companies? And is that making up a massive percentage of the S&P right now?
It is, and I think big tech is where we're going to see further trouble. I think there's a couple of reasons for that. So one, in the first 3 quarters of 2020, especially, big tech was really that deflationary defensive play, and it worked great. And there was a very simple reason for that. Consumers weren't going out; they weren't spending on services, which was a dramatic change for the U.S. economy. Advertisers didn't have any alternative venue except online to funnel their ad dollars into. They still had those budgets. And so big tech, and especially, like the stay-at-home tech, social tech, so like Facebook, Twitter, Alphabet, they all did really, really well.
For sure.
Then we got to this saturation point, and we saw that even at the end of 2020 a little bit. We definitely saw it this year where, for instance, Netflix, which just had another similar situation at its last earnings, saw much lower subscriber growth. And the reason for that is you're not going to get 2 Netflix accounts. And, we're seeing that across the space where user growth is stalling and average revenue per user is also stalling or even falling in some cases. And that makes it pretty tricky for tech because that means their margins are going to start shrinking. At the same time as their margins are shrinking, probably one of the few bipartisan and global areas of consensus is that big tech, especially consumer big tech, needs to be regulated. Well, there's two arguments against this that I hear. One is, well, no one's going to break up, Meta or Google tomorrow. And I would say you're absolutely right. They're not going to. What they will do is drag them through a lot of legal expenses. And that is a really, really dramatic impact on someone's balance sheet. We've already seen that impact start surfacing for Facebook and some of the other big tech names. And then the second argument against this is they say, okay, so maybe they can just break up and you'll get the sum of the parts and that'll be even better. Well, here you forget the economies of scale. When you actually do have an effective monopoly or an oligopoly, you have significant control. And also you have just those simple scale impacts where you don't need to have as many redundancies. So once that goes away, again, that really starts shrinking tech margins. So I think we'll see more of that regulatory burden from an expense standpoint come online in 2022. And I also think the user growth will continue to stall.
It's a question we'll probably save more for later when we get into crypto and digital, but I think I have to ask it based off what I asked in your answer with these big tech companies. Do you think they're a little bit afraid and will be impacted by effectively the rise of Web3?
Yeah, I absolutely. And in fact, Meta is a fear-based move. What I mean by that is Facebook changing their name to Meta, saying we're now a Metaverse company, without a real concrete plan, without owning any significant assets in the space beyond Oculus, which is just one way to have access to the Metaverse and perhaps not even the best way. It speaks of fear to me. It doesn't speak of a well thought out plan that was well articulated and really developed. And so that's a company trying to stay relevant. And as an investor, when I see haphazard moves that are that dramatic, I get pretty nervous.
Okay, let me dive a little bit into that. I know my audience is going to say that I overuse this question, but you're going to get it too, Max. We have, well, we used to call it FANG, but now with Meta changing their name, I guess it's not FANG anymore, but it used to be FANG plus Tesla and Microsoft. The question's going to be, I mean, look back 10, 20 years ago, it was a completely different mix of effectively top 7 or top 10 companies. Which one of those do you think will fall off? They'll be relevant, but they may not be a top 10 company anymore within, say, 10 years.
Sure. I think Meta will be one of them. I think they stretched themselves too thin and now they're acting a little scared and don't have enough focus. There's significant issues at Facebook, specifically the core asset. Instagram was their saving grace, but that's now starting to fall as well due to other competitors like TikTok. And again, if you look at Instagram feature rollout, it's by and large went from copying Snapchat to copying TikTok. That's not really good because Gen Z actually is pretty astute at seeing that, and they'll go to a platform that makes the most sense for them. They've also dialing in a little bit into what concepts that we see in Web3. Just like you can go from one Ethereum wallet to another one, and there's no process to onboard or deboard. You just take your wallet with you and put it into another software package. The same thing is happening with younger generations' consumption of social media. They're not keen on locking themselves into a platform. They'll go to where their friends are, and those transitions can happen very quickly. So I'd say Meta for sure, in my mind, is going to be a lot less relevant as the years go by. The other one I think will be Netflix, and that to me is interesting because it's been such a great company. I mean, Reed Hastings, I think, is an excellent executive, but the issue they're facing is they've kind of went from that point where all other streaming competitors coming online was helping them because it was helping people cut the cord, to where they're actually now in a highly competitive landscape, and some of the competitors now have much bigger budgets and potential to increase funding. And I think that's going to make it harder for Netflix to keep up, especially as they're now really become a studio much more than a tech company. It's kind of interestingly going from one end to the other. They've gone from traditional media to tech back to almost in a way traditional media just through that streaming platform. So unless they can truly innovate, I find it hard for them to keep up.
We're going to come back to Meta in a second. By the way, I probably asked 10 pundit, thought leaders, economists that question. The most common company that comes up is perhaps not going to be at that level in 10 years is Netflix, which probably means, no offense, Max, but that probably means it's going to be a keeper. Because that's just how things often work out. When consensus thinks one way, it kind of goes the other. Back a little bit to Meta. Let me push back a little bit. I mean, 20 years ago, I'm not even sure Facebook was even around. So the fact that close, I think it was 2003. So the fact that within 20 years, this company came from nowhere and is now what, the 4th largest company on earth. Maybe they're getting an early start on the metaverse. Now, here's my important point. They have more users than any other country on earth. So it's well over 1 billion users. I think they may have a pretty good moat. Where am I wrong?
So it's a great point, and a lot of those users are now coming from emerging markets, whereas the US users are declining, and those are the users that actually have the most monetization potential. So unless Facebook figures out a way to produce an Oculus cheap enough to get it to folks in India who don't have, in some cases, even consistent electricity or internet service, and other emerging markets like that, it's going to be tough for me to see how they monetize users that don't have the capacity to spend. I think it's going to be very tricky to proceed in this environment. And to your point about them going from nothing to such a large entity within 20 years, well, I think part of that is just a tech cycle. And, I mentioned earlier, we're now living through what I think is the shortest business cycle in our lives, but a lot of things are compressing. And I think the growth of one company to another, in terms of dominance, is going to also be pretty significant. Where I'd see like a different example, and this is where I see a plan that's been really thought out and executed, was Amazon, where it went from a marketplace for goods that it owned to a marketplace for other, sellers, to really a cloud computing service with a side business in media and e-commerce. And that was a much more thought out and gradual approach. They didn't just come out and say, hey, we're now a cloud computing company. In fact, they still don't say that, but AWS is where Amazon gets all their revenue. So, that to me makes a lot more sense. So again, I might be old school in my thinking on that, but I tend to think that you need to build moats around customers that have the potential to pay you versus just having objective, very large metrics. Now, I do think economies and emerging markets are going to continue to grow. So certainly you can make that counter argument like, well, eventually those users who are now hooked on Facebook are going to have the capital to spend on whatever Facebook is selling them. But this will take me back to what I said earlier. Those new consumers care much less about the platform. They're not keen to be locked in. So by the time they have capital, they may go off of Facebook into whatever the 2035 version of TikTok is, because that's where their friends are. What's where the more interesting content is.
So then if I asked you the question about what may fall off in 10 years, I'll ask the opposite. You may have answered it with Amazon. Before you give your answer, I'm going to lean towards Microsoft. I think they're very carefully getting into the metaverse. Arguably, they might have overpaid, but people said that about Facebook and Instagram, whatever, about 10 years ago. And look how that played out. It was an amazing move for Facebook. Microsoft is the only one that was on the list 20 years ago that still is top 10 now. And if I could go back 10 years prior to that, they were on the list back then. That's no guarantee that's going to continue. But I look at it as it may be kind of a boring pick, but I think that's one that will still be in the top 10. What do you think?
I actually agree with you. I would say Microsoft and Amazon, and Microsoft has over its history gone through dramatic changes, right? And I think Nadella has done some really smart moves. I think it's the sharpest executives that Microsoft has had since Bill Gates, and probably I would actually say sharper than the founder. And I think
that's saying a lot, but you might be correct.
I have a lot of faith in what he's doing with the company. It's methodical. He's not, but he's also like to your point, like buying Activision. It's a huge premium, and a lot of people have said this is a crazy overpayment for this deal. You're buying a company that has significant ESG issues because of the founders, and you're letting the founders stay. It's a pretty bold move, but I think it's a very smart move because it gives them access to a whole lot of areas that they have been trying to break into for a long time, could not break into. And so we're saying, okay, if we can't build it, let's buy it. And if we have to pay, a premium, which again, on an overall scale to Microsoft's cash pile is not dramatically, detrimental, it makes a lot of sense. And now they've got mobile, they've got Metaverse, they've got huge platforms. They've just pretty much, I would say, potentially won the console war, by the way. With that
yes, when you look at it from that perspective,
right? And that's sure. But we kind of we talk about video games as kind of in that pure context, but video games are the gateway to the metaverse, and
100%.
And so owning that also gives them a huge leg up against Facebook now. So there's a lot of things that Microsoft has done that I think are smart, and one thing Microsoft has not done, by the way, which a lot of people have been asking about, and I actually. I think it's interesting. They have not released any kind of VR for the Xbox. PlayStation has released the VR headset. Obviously, Oculus is doing it on PC. There is no VR on Xbox. Now, the new console, the Series X, is certainly powerful to run VR, but they haven't done it. I think that was strategic. And it's a very interesting move. It's almost like an old school Steve Jobs move where you wait for technology to get mature enough, and then you build the best version of it. And we know Microsoft is working on Magic Leap. So they actually even have the tech. So just wait for that inflection point where the metaverse gets a little more mature, and then Nadella says, okay, by the way, here is our version, and it's super polished and innovative. And they've already seen what fails with other competitors. So I think that's where I like Microsoft a lot.
Since you brought up effectively Xbox, I'll get a little bit off on a second. First of all, everyone, go to my YouTube channel. Back in October of 2021, I interviewed the team leader of Xbox back a couple of decades ago, Robbie Bach. And that was a really interesting discussion that led to some of the things that I'm talking about to some degree with Max now. Here's a question that I asked them. It was probably a little unfair, and it's going to relate to crypto. I said, you've been around three of the wealthiest people ever. Now, Paul Allen's no longer with us, but Steve Ballmer, and of course, Bill Gates. Do you think they own like Bitcoin crypto? And he took about a tenth of a second. He goes, listen, I don't know for sure, but like, why wouldn't they? Of course they do. That might have been a little bit of an overly simplistic answer, but my experience, you get a lot of family office that are saying like, no, we're waiting for more regulation. It's too aggressive. We're not sure yet. And then I talk to the billionaires, the wealth creators, and their perspective seems very different than the executives. They're like, yeah, sure. I mean, it may be play money. It may be getting used to it. But like, I mean, I would say like 80% of the billionaires I spoke to own some combo of Bitcoin, Ethereum, Solana. What do you think?
I think the key thing you said there is wealth creators. Wealth creators are also risk takers.
Right.
And so they're comfortable with that. It's very different. I think what family offices I've talked to, if there's next generation or even like fourth, fifth generation, a little more hesitant because they've been inherited the assets. They feel like they're stewards and custodians of those assets. The first generation, where they've created the wealth, they are generally a lot more open to taking additional risk because that's what got them to where they are. And I think that's the right attitude, because the thing to remember is there is always premium markets. Like I can almost explain any security, any asset class through a building block of risk premiums, whether it's paying for getting paid extra for liquidity, for inefficiency, for just broadly buying into something new and untested. You are getting compensated for that. So if you wait, yes, you may have more foresight, but you're also going to lose out a lot of returns. And I think going into crypto for those billionaires at a very small level, which, to folks like you and me would look quite high.
Right. It's probably initially under 1%, but it still is likely 7 to early 8 figures. It's real money.
Yeah. And I think putting in, a few percent into something is the best way to learn. As an investor, with
100%.
thing I tell anyone when I talk to, college students, for instance, they say, how do I learn about investing? I say, however much money you think you can have, unfortunately now with fractional shares and things like
Invest.
Robinhood.
Right.
Yeah. Just like, you can literally do it with $1,000, so get $1,000 invested, and really you'll start learning because you'll have something at stake. Having something at stake is absolutely critical. Otherwise, you really aren't going to be committed.
Yeah, I mean, we agree. And to give a little further context to the audience, I would say on two handfuls, close to 10, I've had over 75-year-old wealth creators say, Angelo, I know you're really active in crypto and digital. I want to be active. Help me directly. So the age is really not as much of an issue, like you said, in terms of them being wealth creators and risk takers. And I've had executives in the family office in their late 30s, early 40s, like they don't even want to look at it. And they don't even have a thesis that makes any sense, but they just think because it's volatile, it's just too risky. I mean, they're not doing the family or the principal a service, but I don't want to go off on a tangent. You said something earlier, although I do anyway, that caught my attention, how it may play out in tech, deflation, and a variety of factors. When we talk about developing countries, especially Europe and Japan, they have aging populations. The US is not half bad for that, but it's not great. But you look at countries like India, Indonesia, countries in the Middle East, they have massive amounts of Gen Z, of younger people. I think we're underestimating the impact that those countries could have and how comfortable a lot of those younger people are in some of the crypto and things that we're talking about. It's just a different mindset and perspective. I think the world is changing, and it may be happening quicker than we think.
Angela, that is a really great point. I'm really glad you brought this up, because this is even more of a secular theme that I've looked at for a while. And population growth and demographics is something no one thinks about because it's very long term. Like we're talking decades, but it is crucially important for economic dominance on a longer term perspective. China's biggest reason for why I think China is going to basically become the largest economy and then very quickly lose out to India the biggest reason is their previous one-child policy that they were never able to resolve.
For sure.
Because now their young working age population is lacking. Meanwhile, yeah, absolutely right. Like you said, India, I think India is going to overtake China because they do have a much larger, younger population that's growing. And here's another interesting thing about crypto that we've seen just colloquially. I think almost everyone probably watching this knows at least one person who got in early into Bitcoin and now all of a sudden has a significant amount of capital. And I think as there's this almost redistribution of wealth through DeFi that occurs very organically without any government policy, but just occurs through people being willing to take chances to learn new technologies and then apply them. I think we can see wealth creation happen much quicker in those emerging markets because to some extent, all you need is an internet connection and then a voracious appetite to learn and a little bit of capital to start investing, but you can pull that capital in a lot of places. And I think that's where we get to that point where the population has enough capital where they can start investing a little bit and already has the appetite and the ability to really take the calculated risks. It can be a dramatic change in demographic shifts more than what we've seen before. And I do think, broadly speaking, crypto assets are going to be a very important part of that.
Yeah, I mean, we're actually probably agreeing too much, Max. Maybe we have a little bit of a disagreement on Meta, which is good. We want to have disagreement. You asked me, and I'm very far from an economist. I don't even have a bachelor's degree. I think maybe not 20 years. I think within 30 years, India will be the largest economy. They're the largest democracy. Here in the US, we should be, I don't know if I'd say happy, but do you really want that to be China? And so India could be not just a great ally. They're young, they're dynamic. Look at all the amazing things that are happening. Now, they almost messed up crypto, and it still is a little rocky, but it looks like it's trending somewhat positively, although that changes almost by day to day. But I would look very, very bullish long term, 20 or 30 years, on India. That would definitely be my perspective as well. Changing direction a little bit, being involved with wealth creators and single family offices, you kind of always hear wealth is created taking risk, being concentrated, and wealth is preserved by being diversified. And again, there's grains of truth to both, but nothing is ever a set formula. But my big picture question to you, going back to asset allocation, are often investors overly diversified? They would be better making more concentrated, let's go with the word bets.
Yeah, so I personally will push back just so we disagree on something on the word bets. I think you never want to make a bet in the market because that implies, at least to me, kind of laissez-faire. I'm just throwing some dice down on at the roulette table, but calculated reallocations, and this is what we talked about a little earlier in terms of wealth creators versus the next and subsequent generations. That is where I think that mentality, if we're just stewards and we're just going to grow at this very low level of return forever, it is hampering the long-term creation of wealth. Not taking enough risk is dangerous, and it can create long-term consequences for families' legacies. So I do think it's important to, just like you said, put in a few percent into something like digital assets, get involved in that, look at emerging technologies. The best way to learn is to invest, because when you invest, let's say as you're a family that says, okay, I'm really curious about, artificial intelligence. And of course I say this with some bias, given that we are an AI company that's raising capital, but they say, okay, I want to learn about AI and what it is and how it works. Well, you could invest into a company because for us and for anyone else, when you invest, you get access to information that the public does not have, because now you are in the investor class. And that's really critical. And I think families need to be smart about that. And that goes to other technologies as well. Metaverse, Web3, etc. It's important to have the mentality of a professional VC where they know a lot of their bets will not work, if you want to use that term, but they'll have some really smart investments that will work out. And overall, that's how they drive that ROI. And I think it's important to, just as it's important to not be too concentrated as you've grown your wealth. You don't want to just say, okay, I'm going to put everything into, this other venture. I mean, I think the only person who's done that really successfully, but I can think of top of my head, is Elon Musk, where he said, okay, made money on PayPal. Now it's all going into, solar. Now it's all going into Tesla. Now it's going into SpaceX, and just continuously rolls like that. I mean, that's a once
Amazing, right?
I mean, and like, let's be honest, there's very few Elon Musks out there. There's probably
I
just
think
one,
there's only one.
unless he may have a clone. We don't know. But barring Elon and his Elon clones, there's really not going to be anyone else who can do that. So, be smart with your capital. Don't allocate it all to highly speculative, risky investments, but also don't allocate none of it to highly speculative, risky investments.
Yeah, I mean, I would say the risk that I see family offices making is being overly conservative, getting, in relatively roaring equity markets, 7, 10, 12%. But again, it's all relative to what else is going on. But they're missing out on what I think over a 10-year window is going to be massive multiples of upside of asymmetrical opportunity. I don't know, who knows, 20, 40, maybe 100x. If you look at now, the crypto markets are down. It's been a pretty bad last 2 months to about 1.9 trillion. I mean, you can't tell me over 10 years that may not 100x. It's possible. Now, will everything else also go up? Sure. So it's all going to be relative to the cost of goods and all that. But that's what I'm basically saying, what I said earlier about inflation. It just makes all the sense in the world. I'll reposition my comment a little bit. Is there an investment for 1 or 3% that may go to zero or near zero? It's not going to go to total zero. But the upside is more than inconsequential, that it may go up tenfold plus. It's worth the opportunity at the allocations that I'm talking about. Now, crazy people like me and others are going to go much, much greater than that. But and this goes to my question that we caught up on off air. And maybe it's a myth, but it sounds good. Supposedly, George Soros said, invest now and investigate later. Now, I don't think that was meant to be overly literal. I thought it was basically form a thesis, do it quickly, allocate a small amount of capital, and then as you get more comfortable, adapt and go up or get out. But the concept of we need to do diligence and understand this inside and out for 2 years, that's not going to work in crypto and digital.
Yeah, I think that the concept, I would just simply say it's explaining analysis paralysis, right? Look, I've been a very long-term investor for some of the things that I've done in my career. I have, I'm a data guy. I've been a quant investor for all of my career. So I understand the importance of analysis. I don't want to, shoot from my hip, but you also, if you take too long to kind of line up your shot, you're the one who's going to be bleeding. And therefore, it's important to get comfortable with ambiguity. As an investor, you're never going to have all the information. Let's again, like, that is just a fundamental concept. You will never have all of the information you want, and the information you do have is going to be variable and it's going to be changing. And so you have to get comfortable making those decisions with imperfect information. And you have to figure out where your comfort level is, and probably where it is, if you're not used to this, is it's way too far in the realm of definitive facts than probability. Thinking probabilistically and making investments on a probabilistic basis is a core component of sophisticated allocators.
I think what you just said, Max, if we have young investors and college students listening in, that was like really incredible insight, effectively getting comfortable with the uncomfortable, which is why I always also talk about the value of even chess and specifically playing poker. There is luck involved. There's also analytical involved, and it changes effectively by the second or by the minute, and you need to adapt your decisions. You can't anchor. Things are changing so rapidly, and many of the things that we're talking about, that you need to adapt. So those are, excellent points. You said it more eloquently than me. I got a little bit of a part 2 to that, but we'll save that to a little bit later since we still have a fair amount to cover. I've had on several value investors in 2021. I respect their intellectual firepower. I enjoy them personally. A couple of them, ironically, seem to be really intense Russian chess players. So kudos to them on that. And I know things go in cycles, but I do scratch my head. Value investing. I think every investment I do, I want it to be a value investment. These people have been knocking Tesla for years. They got crushed over a 10-year period. They haven't gotten into crypto. Hello, Bitcoin was the greatest performing asset class over a 10-year period of all time. Of all time. I could go on and on. Eventually, a broken clock is going to be right. There'll be periods where they're correct. But to be anchored in value investing, and we may disagree here, like I'm scratching my head a lot. I just don't get it.
Yeah, no, it's a good question. And one other kind of foundational concept for me is to never be anchored in your beliefs when you're an investor. So I naturally know, but I have a bias towards value because I like things that are cheap. Maybe it's because I'm also Russian, although I'm not as great at chess. But I mean, as a first generation immigrant, I like to buy things at a discount. And that translates to my natural proclivity for investing. But again, to my earlier point, get comfortable being uncomfortable. So sometimes you get on a momentum play, and Tesla for me is something where I cannot value Tesla as a car company. I cannot value Tesla as a tech company. It's very hard for me to understand how it's priced where it is, but I also don't dispute the fact that it's priced where it is and it has strong momentum. And that is something that investors need to get really, really comfortable around, saying, well, eventually the market catches up to what we do. I would say read the story of Julian Robertson, probably one of the greatest investors of our time. Had
For sure.
the original Tiger Fund, had the right call on a .com bust. Unfortunately, he had it about a year too early and lost the entire fund. And that is something that we've seen happen in other cases. I think Julian is just, in my opinion, a case of not even hubris, because it wasn't that he was too proud to change his mind. He really had conviction, and it was the right conviction. But the market can stay irrational longer than you can stay liquid, and that's really the case there. So when it comes to factors like value or growth or anything, don't get married to your philosophy.
Yeah, like you are just dropping some significant knowledge there, Max. I mean, this should be played in like all colleges for young economists and investors. And this is real world. And no offense, professors are wonderful. They're brilliant. We all learn from them. But you really need to be in the trenches because it is, it's irrational. It doesn't make sense. There's lots of different factors. You really need to be nimble. I gave the poker example earlier. Could I make the argument? Definitely in crypto, I mean, you may disagree that like your past knowledge, what you learned and what you might have even been successful at, it might be detrimental. Not only is it not helping you understand how things are changing and rapidly evolving, it might even be holding you back.
I would say that's very true. And actually, this does dovetail into why I left my old, very large post to join AlphaTrAI to build AI strategies, because the whole concept behind a neural net based strategy is that it learns dynamically and it evolves. And I think that's the single biggest thing that most human investors and even most quantitative investors miss is they do not evolve with changing realities, and they have a lot of biases. I mean, Angela, you mentioned anchoring, which is a big one. There's recency bias. There's
right. Confirmation bias, etc.
Exactly. All of those things exist, and then, by the way, they exist certainly in human investors. They also sometimes exist in traditional quant models because of how they're written in a very formulaic way. And so that's something that is really important to forget about. And you need to look at each day with relatively fresh eyes. Doesn't mean you forget history. There's obviously value in that, but history does not repeat. It rhymes, but the rhyming scheme changes. And that is something really, again, really central that folks need to understand. And removing bias and being able to truly internalize that approach, that's crucial. And for me, that's why actually I think AI can be the next generation of investing, because it just by design operates like that.
Let me think how to phrase it. So traditionally, those in college learning investing or those out there in the real world were taught to, have an investment thesis, investment policy statement, asset allocation, probably in the past skewed to be more strategic. But when something grows and it goes now outside of the boundaries that you set for asset allocation, you're supposed to trim that off, pay your taxes, and diversify again into your asset allocation. And on the surface, that doesn't sound half bad. I could argue that family office is different from institutional investors with the taxable implication. However, I'm thinking about crypto, and again, your past knowledge may be a detriment. I don't think that's necessarily such a good idea. Now, my son's philosophy on crypto maybe is not a bad one. It's more conservative than mine, actually. And that basically is when it doubles. So we're making that assumption. Of course, that happens all the time. You sell the amount that's your basis that you put in. So in theory, you can never lose money and you let the other part ride. But to think that I'm going to limit it to 2%, and once it goes above that, I'm going to keep on trimming it off during a rapid bull market run, that is absolutely not, in my opinion, a good idea.
So I would respectfully disagree with your son. But I would agree with you. So we're going to have to find more.
Yeah, like I'm the more aggressive one.
Well, you are. And I think, again, you hit on a key thing. Crypto is a fundamentally different asset class. I think one of the biggest mistakes that I've seen investors make, who I know are getting into the space, is they take those traditional notions. And by the way, rebalancing and trimming your gains is a very traditional finance notion. It works well for certain strategies. And so I think your son has a good idea. I don't think it's the right idea for this asset class. And I really think the way to approach crypto is to understand that it is a fundamentally new asset class. We have not had a fundamentally new asset class in the world, maybe you could say since Mike Milken made high yield bonds. And, perhaps the first kind of, collateralized products came out, and even those were just derivatives, almost actually by definition derivatives of existing things. So this is even more fundamentally different. So taking what people know from Forex or from equities or from fixed income and trying to map that onto this asset class, it will not work. It has to be a new approach. And that's tough because, if I talk to any investor who's done really well, and they, and these are folks who understand the opportunity and the value of the blockchain and of crypto assets and of DeFi. And I talk to them and I say, you know what, it's great that you understand this, but now you have to basically start at ground zero.
Yes.
Start with that beginner's mindset. Nothing. It's tough. I mean,
it's not easy for people that have had some level of success. Right.
Yeah. I'm in that boat. I think the only thing that I can say, maybe I'm trying to do better, and this is again in part because of where I'm at, is I'm taking that approach of like, I'm not going to bring TradFi to DeFi. I'm not going to try to build a model that takes, things that I've learned from trading Forex, from trading commodities, from trading equities. I mean, over my career, I've traded pretty much every asset class, and now I'm going to be, working on investing into this one, but I'm not going to move any concepts over. I'm going to start from scratch. And it's tough to do, but I think it is necessary if you really want to generate alpha within the digital asset space.
For sure. To give the audience some context, we have about 30 to 40 minutes left. We're going to segue into artificial intelligence in a second. We will also talk a little more about crypto, about Gensler SEC regulation, when institutional investors could come in, what could that mean to the market? We'll talk a little bit about the Donald Rumsfeld unknown unknowns and AI and tech. So we have a couple of things still to cover. I'm going to give a little bit, and I think Max would agree, a little bit of an understanding. This podcast is for educational and entertainment purposes. These are Max's personal opinions, not necessarily those of his company, and effectively really the same with me. And a lot of this is so fast moving that we're recording this on January 21st. Within, I don't know, a minute, an hour, a day, a week, opinions could change. So again, really look at it from an educational perspective at the end, or more entertainment. And really at the end of the day, you know what? You have to do your own diligence. because when you invest, you absolutely could lose money. You might even lose all your money. So you need to really understand that. You really need to understand your time horizon, your liquidity, your risk tolerance, a variety of different factors. You need to think for yourself and make your own decisions.
You've made
Okay.
my compliance guys very happy.
Yes, so we'll do a little mini version of that to wrap up too. So compliance people, finally, for the first time in my life, will actually love me. Let's segue into artificial intelligence, AI. It's a term we often hear. It's technically been around since what, the late 50s. What is it really? What's a definition in today's world of AI?
Sure. So I think, again, you're absolutely right. It's a term that gets spat around so much that it's almost lost meaning to some extent, especially within, certain communities like in finance. So the way we would define authentic AI is that, number one, it's got to be autonomous. So it has to work on its own. It does not need human intervention in any form, by the way. That includes adjusting the models or sort of tweaking the models. Now you can do that to improve the algorithm, but it cannot be a requirement where, every year, every quarter, a human must intervene somehow. So it has to be able to be fully autonomous. Two, it has to be proactive. What I mean by that is it has to be able to function on its own, make its own decisions within that autonomous layer. It decides when to act and how to act. And then as it acts, it learns from those mistakes. This is actually a really critical component that differs what I would say is true authentic AI from more unsophisticated approaches, which would be a lot of machine learning algorithms where the learning is not as sophisticated. It's a true AI process can understand the difference between success and failure. It can make adjustments based on those results. It can actually rewrite its thinking completely. So it can generate a new formula, if you will, for how something works based on what it's seen and how its decisions have had a positive or negative impact. And then it needs to make those decisions in real time. So it has to continuously be looking at how to acting proactively, learning from those actions, and then making real-time adjustments. So that to me is as simple as I can make it, way of defining what is authentic artificial intelligence.
Is investing with AI truly different from all quant strategies that are already out there?
I would say so. And there's a couple key differentiators. And by the way, I say this as someone who's built almost every kind of quant strategy over my career, from top-down systematic macro to CTAs to even quantamental strategies, where I used both machine learning models as well as my own economic views. So I've been around the block, and this is why I think AI is different. The key reasons: number one, AI can adapt to things we have not seen before very quickly and on its own. Again, going back to what I said about it being self-learning. So let's say when negative rates came out, that was a big one. So at the time, I was running a quant macro strategy, and it was investing in fixed income, and it didn't really understand what just happened, because now all of a sudden, how do you discount by a negative rate? Well, you have to go in as a human and now tweak that model, and you're trying to understand how it all works too, and you're working in real time. It's basically like being a mechanic on a race car that's running. It's tricky, and you can lose a finger. And with AI, the difference is it's like a car that can fix itself, or it says, oh, we're now in different terrain, so I'm just going to change my tires from road tires to all terrain, just like that. It's a pretty remarkable difference. Two, it is not bound by bias. And bias is a tricky word, because a lot of folks will say, well, quantitative strategies aren't bound by bias. And I would say, no, they're not bound by emotion. And that's a key differentiation. Emotion is, all those human behavioral fallacies we mentioned earlier. Bias is inherent in what you do and how you structure things. So if I systematize my way of thinking, or if I systematize an economic theory, that theory is inherently biased. I mean, as an example would be what, again, to use a previous thing we talked about, value versus growth. If I believe that value will generally do better than growth, and I build a model that generally will pick value over growth, well, that model has a bias. If I build a deep learning network that looks at value stocks, it looks at growth stocks, and it just makes a decision based on a continuously evolving set of features, which style it likes more, that has no bias. That's basing its decision on the current facts and what happened before. Um, and I would say those are really the most important distinctions between AI and quant investing.
I'm going to try to bring it back to investing, but it brings up some bigger picture questions that I've asked global thinkers and thought leaders relative to AI. One, I mean, Google's DeepMind seems incredibly powerful. Does the government have AI that is way more powerful than that we don't know about? How are developments in Russia and China? That may not correlate to what you guys and others are doing, but honestly, you're not going to have the money or resources that a sovereign nation like the US or a gigantic company like Google
Sure.
has.
So it's a fair point, and it's a really interesting one, right? Because I will say one thing: I'm really glad that the U.S. government is not launching a hedge fund, and neither is Google. Last time I checked. So
Well, they would
makes,
probably be so bureaucratic they would mess it up anyway,
yeah,
even though they have all the
but
resources.
you hit on
they
a key
need.
thing. Actually, you just hit on a key thing. Remember, this is something where you're building an artificial intelligence that thinks on its own. So it's kind of like you're really, the way I would explain it is you're kind of giving birth to this baby, and then you're trying to give this baby a really good education, and then set it off on its own to learn about the world and act and become an adult. And just as we see that sometimes children, and this actually applies to families, we sometimes see children from very prominent families not do so well, and we see children from, much less well endowed families do tremendous things. We can see the same thing with AI, where you can have a really small and talented team, like I would say the team we have here, build some really incredible IP and build something that really does work and then continues evolving on its own. While a very bureaucratic giant company, even though it has tremendous resources, is unable to do that because they're have to run every decision through committee, and a lot of great ideas get shut down instead of actually even going back to what we said about investing, taking a chance and letting a new idea really permeate and seeing what happens. So I think that's where we actually do have a bit of an edge in terms of not being bureaucratic. But yeah, there's definitely a lot of money being put towards AI. I think while right now I would say we're probably one of truly a handful of asset managers using that authentic version of artificial intelligence. There will be others, and my goal with the company and my team's goal is we want to have our first mover advantage and go as far as we can. And I mean, honestly, I welcome the competition. I've talked to several folks in the space, and again, there's not a lot of them, but at this point we're all very friendly because we're doing something different and unique. Another thing that's great about AI, and this is actually another differentiator from quants, because AIs think independently, you don't have that crowding that you see in a lot of traditional quant strategies. So if you remember the flash crash that happened in the aftermath of the financial crisis, the last one we had in 2008, well, that's because a lot of quant models were running the same exact signals, even though they were developed independently. They were using the same data. The formulas were generally the same, and it was formulaic. And so they crowded towards these one subset of stocks. And then when stocks started falling, all of a sudden, those funds started having losses. They were leveraged, so they got margin calls, and this created the snowball effect. But what I see with artificial intelligence is each individual AI will generally think a little bit differently. And so there's much less crowding. It makes the strategies more differentiated from each other and from what else exists. And that's, for institutional investors, is a huge advantage as well, is that it tends to be highly diversifying.
Trying to ask my next question with somewhat of a straight face, but I'm actually serious in asking it, and we may be decades away. But with the advent, like you said, AI thinking for itself, eventually likely getting singularity, may we have investment companies that are they don't need you, Max, or others. Could you see a future in 40 years where AI is launching its own vehicles for us humans to invest in?
I mean, I think I could see a future where AI is launching vehicles for other AIs to invest in. I'll take it one step further. Let's think about this for a second. We have a concept right now called a DAO, right?
Yes, we
Which
do.
is and think, I mean, that would have seemed completely insane, probably 5 years ago. That there's giant multi-billion-dollar entities that don't have a board in a traditional sense, don't have workers, don't have really even like a clear institutional investor base, and yet they exist and they operate and they're doing really interesting things. So when we blend decentralization with artificial intelligence, you get to some pretty interesting futuristic possibilities. And again, I try to have an open mind about these things. I think as an investor, this is I've been trying to give these maxims throughout the podcast. This is another one. Don't ever have a closed mind to an idea. Don't ever say this is silly and therefore it'll never work, because great ideas are first ridiculed, then copied, and eventually we're accepted as facts. I think I'm misquoting Schopenhauer when I say that, but that's that is something that happens. And again, we saw it happen with cryptocurrencies. I mean, think about everyone who was writing off Bitcoin as a fad, as something that is really,
like Nobel laureates, like Paul Krugman.
Yeah. I mean, and and Paul has said a number of things that turn out to be not quite accurate.
Yeah, it hasn't been a great 20 years on investing or technological thought leadership from Paul. That is true.
but this is, there's other folks who are very good investors. And again, like the good ones, I would say, were the ones who at least said it at first, well, this is kind of a fad, I don't buy it. And now we're launching crypto strategies because they say, okay, I was wrong.
Of course.
And actually, there's a lot of value here. I think for me, the biggest one of these that is interesting is Jamie Dimon at JP Morgan, who has very famously been very anti-crypto. And you slowly see his story changing to the point where now JP Morgan just launched a crypto research unit, and they're doing a lot of other
I think what he says is a total misdirect to trick other big banks.
Potentially, he's a very smart chess player, to bring it back to your chess player analogy. But it's really fascinating to me where you're starting to see that adoption within crypto, whether it's tacit or cloaked, like perhaps Jamie is doing. It's we're getting to that point where the idea is now being copied and permeated further. And then eventually, I think we're going to get to that point where it's just a fact that you can transact in a permissionless, trustless economy, and it has huge positive ramifications.
Why do you think AI can work well actually in the digital asset space?
Sure. So I think one of the biggest reasons goes down to what AI really needs for its food. So if AI is a baby or a human, its food is data, and it needs the most nutritious data possible. And that most nutritious data is the cleanest data. Well, by the very definition of blockchain, you have highly clean data sets. Every transaction is recorded. It's immutable. You can't change it unless, you get to a hard fork situation, which also can actually be identified, and then you contract the two blockchains. So even if that happens, you have very clear recourse to aggregate the data. And that doesn't exist in any other market at all. I mean, even crypto dark pools, all they really do is they just break the transaction down so you can't track it to one wallet, but you can still see all the trades. And with that, you also have tremendous inefficiencies. And those inefficiencies is where the AI can really create opportunities for itself. That's where it can really take advantage of patterns that are not immediately apparent to humans. And that to me is this perfect trifecta where you have high inefficiency, you have really, really, really high quality data. And at the same time, you also have high volatility. So that is the trifecta for, I would say, the most fertile ground for an AI to excel versus other approaches.
Let's get a little bit into potentially AI and risk mitigation. And I am going to quote, it seems like about every 10th podcast, I quote Donald Rumsfeld. He actually really had one of the greatest sayings that I think is so valuable from an investor perspective. It's very short, but I'm going to read it. As we know, there are no knowns. These are things we know. we also know there are known unknowns. That is to say, we know there are some things we do not know. The idea of known unknowns can be helpful in forming a financial strategy, I would assume, for a family office. So maybe kind of threefold. What do we already know? What are known knowns? I'm assuming AI and advanced tech could look back historically and could maybe, through certain factors on political unrest, interest rates, inflation, the price of gold, copper, I have no idea. It's probably taking in all those that are coming. It could make some assumptions to the risk of known knowns, correct?
It absolutely can. And I think with known knowns, what AI can do is interpret that data in a differentiated enough way to shed some light on the known unknowns.
Yes, that's where it gets to me interesting, which maybe relates a little bit to the part two of that. Are we conscious of what we are not exploring, the unknown unknowns? And could AI simply do a better job of it than we could?
So that's actually a really key point. And I think especially within, as we get kind of away even from crypto, but more towards DeFi and Web3 and really advanced
Right.
brand new technologies that are just emerging where a human can't track the progress, even though to some extent, or really right now to a large extent, all DeFi protocols are built by humans and then they're kind of unleashed and humans interact with them. But there's so much of them that it's, it becomes very difficult, if not impossible, for any group of humans to actually track that. And see what the implications of a new protocol or DeFi application are. That's where AI, based on the known knowns that it's analyzed, and then forecasted the known unknowns, can go into those unknown unknowns and start making predictions for what is going to become more important. So you can basically take something from an unknown unknown to a known unknown to a known known quicker than a human. I'm not saying that it can do something that a human in this particular example cannot do objectively, but what it can do is do it quicker and on a much larger scale. And when we think about investing, speed and breadth are two very important factors for consistency in alpha generation.
And I mean, I guess that goes back to some things that I brought up and you built upon earlier. There are biases and unconscious decisions that as humans we make that AI, depending on various levels on the quality and the advancements of it, it is not going to be subject to biases. You wouldn't think. Part of it's going to depend, I guess, on the inputs, but its capability, like what DeepMind is doing at Google and others, is like, wow, like look at what DeepMind did with that. What was that game again? That, oh no, computers will never overtake humans.
I think it was Go.
Yeah, Go, and it did it so quickly. I mean, we are just naturally subject to anchoring biases, unconscious decisions, and you would think that AI just eliminates that.
I think it can, and this is where one thing where, because you do sometimes hear about bias in AI, so I do want to address that. This is usually not, in fact, I think it's never been talked about AI in a financial context. It's more in like housing approvals or other things where you say, oh, AI, this AI is denying loans to certain demographic groups. That's a data issue. It's not that the AI is biased, it's that the data it's being fed has a bias in it. So that's a really important distinction. And again, bringing it back, the data has to be high quality and it has to be clean. If the data has a bias, then it takes, I would say, a more sophisticated algorithm to identify that bias over time. And it'll initially start with having that, perhaps bias that the data had, and eventually it'll realize, like, wait a second, I'm denying loans to the subset, and there's really no reason to believe that the subset will not be able to pay, but you're going to need to let it run for a while. And that's where humans get concerned, because they're like, well, right now it's doing something that it shouldn't be doing. But it is a learning model, and the bias will dissipate as it gets additional data. And again, in its learning function, penalizes itself from mistakes that it made. So that's something that we'll see. When it comes to financial data, we just typically don't have biased data in that traditional sense. And right. I'd say certainly within blockchains, we don't have biased data in that traditional sense.
Switching over again, we seem to go in and out of it, but maybe that's good. In Bitcoin and crypto, this is going to be an interesting year because it looks like things will come to a head. relative to Gensler, the SEC, regulation, when it comes to Bitcoin and crypto. And yes, being a libertarian, I don't necessarily like that. That being said, it's inevitable. There'll be compromises. Some of it I'll be okay with, and some of it probably not. And that may evolve as the years go on. But the big picture that I'm getting to is institutional investors are chomping. I know, I talked to them. They're chomping at the bit to get involved, even if it's 25 basis points, 1, 2, 3%. They want to be involved in crypto. They have massive amounts of money, but they need clarity, at least if they're US-centric organizations, on regulation. So I could see a sideways to bear market, which it's kind of been like that for the last 2 months now. And then once we get clarity in the spring or summer, potentially it could be a tremendous bull run. Maybe I'm thinking too optimistically, Max. What do you think?
Well, I think that we do need regulation for institutional adoption. Now, we can then discuss whether regulation is good or bad. I'm probably here. We'll push back on you, even though I am personally probably more of a libertarian than anything else. I think sometimes regulation is a necessary evil in a realistic world. But I also think in this case we do need it for institutions to come in. They need to understand what a cryptocurrency is. Is it a security? Is it going to be governed by certain rules? How is the IRS going to treat it? How do they market to market? What risk level does it have if you're, a company that has to have risk-based capital like an insurance firm? So those are all questions that have to be answered. Gary Gensler is, while not universally liked, he does at least have that very rare quality in the regulator where he understands the space he's regulating.
He was at MIT effectively when Bitcoin was kind of initially
and he led the cryptocurrency program there at MIT Business School. So, I think at a minimum, he's someone who has the depth to be able to opine on the topic. He also did hold the top role at the CFTC. So he's been on, many sides of the securities industry. And I think in that regard, it's plausible that for a technocrat, he'll write some pretty good regulation. I'm not holding my breath necessarily because I know that in government, a lot of times the best ideas are quickly laid to rest in favor of committee and mixed interests. But when we do get that regulation, I think you'll see two effects. First, I think you'll see the retail investors, which are currently still the most dominant force within crypto, run as quickly as kids who see police sirens at a party. And then you'll have the adults show up and be like, oh, this is some really good wine. Maybe we'll have a little bit. And that's going to be the institutional investors. So that's going to create a very interesting situation. I think it's going to create potentially a good trading opportunity. Again, not investment advice, but it may create a situation where we see a dip in the asset when regulation first comes out. And then as it gets adopted and institutions come in, it will create a swell in the price of Bitcoin and other top cryptocurrencies again. Now, here's
yes, please.
Well, I was going to say the other thing that to me is really interesting about this is what we could see happen is, and I think we'll see happen, is the centralization of top cryptocurrencies. So we're going to go from a truly decentralized model where it's a lot of wallets holding a little bit. And, we know there's those whales that hold a large amount, but generally don't move. Well, we're going to see a much more of a centralization where now a much more of the wallets are held by institutions in large numbers, held by custodians in even larger numbers, and even held by exchanges that are custodians for the individual investor. That has major implications for the top cryptocurrencies. And, will that lessen their long-term potential to remain the top currencies? I think it probably will. And that's going to be very interesting, more, again, kind of secular rather than cyclical shift to look at.
Let's go a little quick round robin on some crypto issues. And given we probably have about 7 or 8 minutes left, we'll just keep it fast paced and maybe a little controversial because we could then have you back and dive deeper. In 10 years, what will have a bigger market cap, Bitcoin or Ethereum?
I think Ethereum will, and it's because of DeFi. I think we're the thing that will change my view is if there's another faster blockchain that's better than Ethereum that starts to dominate Ethereum. But even
Well,
then,
I mean, are you seeing that in Solana?
yeah, I was thinking about Solana when I said this. So, there's, when you don't have to pay the gas fees and you can get transactions done quicker, it's kind of hard to compete. So, but remember, Ethereum is an active project. So can Ethereum return? Think of Microsoft. Over 10 years, can we have in the super compressed cycle now, Ethereum go from losing to Solana and being behind Bitcoin to being ahead of Bitcoin and Solana because of DeFi? I think it can.
I mean, I could throw in others, Avalanche and others, but it seems like they would have a long road to go. But 10 years in the world of crypto is a lot of time to work with.
Several lifetimes even.
Yes, yes. Do you think that will you see a point in your lifetime where over 50% of our life will effectively be virtual in the metaverse?
I think so, yes. I also plan to live a pretty long time. So,
so you're giving yourself a big window there.
I'm giving myself a nice long window.
I mean, I think that will happen in 10 or 15 years.
But I do think it's going to happen. Right. And again, I try to have an open mind around it. I think there's going to be a lot of growing pains, but the technology is getting to that point where, kind of, it won't be a Ready Player One experience, but it'll be more like your Cisco WebEx is now holograms, and the virtual office feels like a real office because you're wearing HoloLens, and when you turn your head, you're actually seeing a coworker who's not actually physically there. I think that's going to happen much quicker than people expect.
And Max, what do you think of NFTs?
I think NFTs are misunderstood, and they're misunderstood by both the bulls and the bears, actually. What I mean by that is NFTs ultimately, it is a fundamentally unique token. And what that means, whether that's an art piece, which is kind of where a lot of the speculation has been, or a collector item, or if it's your identity, like your, Ethereum wallet, that's just two applications we've seen. I think there's a lot more things we can do with NFTs, and the speculative, programmatically generated art, and perhaps even art in quotes. I think that's more of a fleeting phenomenon, although a very interesting one. And, I think it has potential, but we need to think about NFTs a lot differently than we currently are.
Completely. And even if it's just digital art, and we could debate that at the moment, that's a massive market. And you could argue with Generation Z, it's bringing younger people into art. Will it upend traditional art? I think it'll have a major impact over the decades. It's much, much, much deeper, like Max just noted. So for more of the novices than just digital art, the tokenization of physical assets, of real assets, what could happen to future deeds, birth certificates, driver's license, the concept of effectively Web3, blockchain, and NFTs is not going to go away. Okay, Max, for the first time since I got it about 2 weeks ago, you will see, and I will reveal to the world and all couple of hundred people that probably watch my video, which is not as much as I would like it to be. I want tens of thousands. I am such a believer in NFTs that I have this. I don't know if you guys could see it properly on screen.
Wow.
Probably not. Yes, it's an NFT tattoo. I mean, I got to probably come up a little bit more. There it is.
Here's my question, Angela. Did you mint that tattoo?
I may have to give up my arm, but for the right price, that might be worth it. So I don't know how many people in the family office world are getting their body permanent art put on it relative to digital assets. So maybe in the conservative family office world, I'm the first one. Much more to come on NFTs. We host a whole bunch of family office boot camps about how to mint and create NFTs and how to buy, and the overall big picture of NFTs and the value. So stay tuned, much more coming up on that. We've been going a little back and forth on it because I think it's really a great concept to understand. And I think no one probably does it better than a pundit and thought leader who actually is very active in NFTs as well. I highly recommend Jonathan Bales at Bales Football. He's kind of a gambler at heart on Twitter, by the way, so that's Bales Football. I've asked him to come on about 1 million times. He always tells me no. I probably need a lot more subscribers to my YouTube platform to get him motivated. But here's a comment of his. It's difficult to admit what you don't know, but it's really difficult to recognize that much of what you think you know probably isn't even correct. I could put that another way. Is 90% of what you know effectively bullshit in using it in practicality in the real world because it changes so frequently? I think we kind of covered a good part of that earlier, Max, but if you wanted to add a little bit of a parting comment, that probably wouldn't hurt.
Yeah, I think it goes back to having an open mindset and understanding that the things you know that are facts today may not hold up tomorrow. And as long as you're willing to accept that and evolve with the changing realities, you can do relatively well, I think, as an investor.
Do you think that, I mean, Web3's complex with the tokenization and how that could play out? And I think you also hinted at it earlier when we discussed India and others. Do you think that the Forbes 400 could be rapidly upended by crypto, digital asset, AI, effectively things relative to tech and crypto within the next, forget 20 years, 10 years?
I think so. And I think what you're going to start seeing is the also the falling relevance of metrics like that. We're kind of seeing it now. I mean, NFTs are a great example where a lot of the crypto elite, if you want to call them that, and I probably wouldn't want you to call them that, but rather than buying a boat or like the original Bitcoin hodlers would buy Lambos, well now they're actually buying NFTs. Like they want to be in the Bored Ape Yacht Club.
That would be the one they would buy.
Yeah, and that's kind of that's the new status symbol, and
yeah, it's
right. That's the new flex or the new drip. Is to show that I've paid 100 million for something that is not even tangible, and how that's going to change things like status is a whole other, geopolitical and social discussion.
Yeah, like I got a text. I always get this question, and it's a fair question. I mean, I probably would have asked it myself a year ago. Like, really, Angelo, it's like a JPEG. I mean, I take a picture of me near a $20 million mansion, doesn't mean I own that mansion. I go to the Louvre. When you leave the Louvre, they bombard you in the souvenir store to buy very good looking replicas. Or I could go online of the Mona Lisa. I could put it in a beautiful frame. It's worth this. It needs to be authentic and original and proven as a form of ownership. That's the key point of something that's scarce and has value.
That's the key thing. The scarcity, but the scarcity and the uniqueness and the authenticity are exactly what NFTs are about. I mean, I bring this up to a lot of folks I know in the art world, where I always ask them, like, well, because these are usually folks who are kind of aghast at NFTs, perhaps because they're afraid that their art value of their own art collection is going to drop.
They're afraid.
But I always ask them, like, is the value of your art the canvas and the paint? Is the value of your art the fact that this was signed and authenticated by the artist? And they always say, well, no, it's the artist. So then the medium doesn't really matter, does it? I mean, again, think about Ansel Adams and buying a print, of even if you have the negatives, that's something that could actually be literally infinitely replicated. But the reason why you pay so much for the AP print is because it's authentic. Think about things like with Old Masters, the catalog raisonné, and all the lawsuits that have happened over whether a certain Rothko or a certain Monet is or is not part of the artist's actual catalog. Well, all of that is solved with NFTs, by the way. There is no question
for sure
of authenticity. There is no question that this is a piece unique. And a lot of the old school art people, which you would think if they had an open mind would actually be pioneers of this, because again, you are not buying an art piece for the physical art. You're not buying it for the materials.
Right, because that could be replicated and look amazing, by the way.
Yep.
like just as good.
We've seen great forgeries, clear auction houses. Every single Sotheby's, Bonhams, Christie's, they've all been known to sell, forgeries for many, many millions. So that will never happen with an NFT.
Absolutely. We're going to get to how people could learn more about AlphaTrAI and connect with you in a second. I'm just going to kind of restate what I said earlier. This is for educational and entertainment purposes. Opinions a variety of regulation. Who knows what could change? It's the 21st of January, 2022. Max is representing his own points of view, not those of the company, and the same with me. So again, you must understand, do your own diligence, make your own decisions. And when you invest, you could absolutely lose money. And I'm going to go with the stark statement of you could lose all your money. Like, you need to make a decision on your own based on your own individual risk factors. Max, and by the way, Max's last name is Gokhman, the CIO of AlphaTrAI, AlphaTrAI. And maybe as I'm allowing you to share your contact info as you want, you could also, for our live participants, type it into the chat feature of Zoom, so it'll be a little easier for them to access. But of course, many, many more people will watch or listen to this. If you wanted to provide either a website or an email, feel free to, Max.
Yeah, you can find us on alphatrai.com. We have a lot of our materials on there, including educational content, and certainly with Angela's permission, we'll put this podcast when it airs as a direct link. Hopefully, get you a few more subscribers.
Yes, I need more.
Yeah, just go to alphatrai.com. It has an overview of what we're all about and a way to get in touch with us. And I would be very happy to talk about AI with any family or even just a curious investor, or any of the topics we discussed. Feel free to get a hold of me.
Great. One, I really enjoyed my conversation with Max. Even after an hour and 45 minutes, I left questions on the floor, so we'll definitely have him back. We'll also see how our predictions and things evolve as the year plays out, and probably within 6 months, simply from that perspective alone, have him back. We are going to try to speed up the production of this and pop it up on my YouTube platform, not the normal 2 to 3 weeks, but I think we could get it up next week. At Family Office Association, we're very active doing in-person events more than ever before. So perhaps my digital programming won't be 2 or 3 a week. It may be closer to 1 a week. If it's not too late, depending on when this goes up, I'm hosting an event that is going to be NFT centric in New York at an amazing resort in the winter. I know that's not without risk in New York City, the Margaritaville, by the way. It's awesome. That's going to be Wednesday, January 26th. I'll then be, lucky for me, being in the Northeast, in Florida. I'll be in Miami hosting a multi-day event at the Fontainebleau, February 3rd, 4th, and 5th. And I'll be back in Florida the week later hosting a private dinner in Palm Beach on February 10th. We have other programs planned, actually 3 in LA, more roundtable and intimate-like. And we are at Family Office Association back and busy with in-person events to supplement my masterclasses, my digital, and the other intellectual property that I offer and the company does. Everyone, I'm Angelo Robles, host of the Angelo Robles podcast, the founder of Family Office Association. Go to our website and learn more about membership at familyofficeassociation.com. Follow me on social media. We're Family Office on YouTube. I'm Angelo Robles. Meta, of course. What else? On Instagram. And you can find me on LinkedIn. If you go to LinkedIn, my personal page, you'll see my Flex, which is an NFT that I own that replaced my picture as my profile pic. Why I picked LinkedIn and not Twitter makes no sense at all, but maybe I wanted to keep the world guessing. What can I say? Max, it's been really great to have you on. I look forward to having you on in a couple of more months. Thank you so much.
Thanks so much, Angelo. It's great to be here.
My pleasure. Thank you. Goodbye, everyone.